Greetings, ladies and gentlemen, and welcome back to our channel. I'm genuinely delighted to have you here. Today, we're traveling thousands of years into the past to uncover the origins of one of the most important and most well-known trading documents in bookkeeping, the invoice. Long before Italy, long before double-entry bookkeeping, and long before the word invoice even existed, ancient Mesopotamians were already recording their financial obligations. Around 3200 BCE, farmers, bakers, metalworkers, and traders used clay tablets to document who owed what, how much grain was delivered, how many animals were sold, and what needed to be paid. These tablets acted as early invoices, proof of obligations, proof of delivery, and a record used to settle disputes. They are the ancestors of every modern accounting document we use today. So, what exactly is an invoice? According to standard UK accounting practice and guidance from bodies such as Institute of Chartered Accountants in England and Wales, an invoice is a formal document issued by a supplier requesting payment from a customer for goods or services provided. An invoice normally includes who the supplier and customer are, what goods or services were delivered, when they were supplied, how much is owed, and when payment is due. Invoices are legally recognized financial documents. They form a part of the audit trail and are essential for VAT reporting, revenue recognition, and accurate bookkeeping. For the seller, sales invoice, it creates accounts receivable. For the customer, purchase invoice, it creates accounts payable. A proper invoice should contain supplier name and address, customer name and address, invoice date, invoice number, unique ID, description of goods or services, quantity, price and totals, VAT breakdown, and payment terms. These elements ensure the invoice is complete, auditable, and compliant. An invoice number is simply a unique identifier, ID. It does not need to be a number. Its purpose is to be unique, trackable, and logical. It can be 001, INV 2025-07, Q1-25-NIC-04, or 31/7/2025. For new businesses, using date-based invoice IDs avoids the impression of being new or having few customers. Example, instead of invoice 0001, use INV 2025-01 or 2025-07-31-A. It appears professional and avoids signaling that your business has just started operating. It's important to remember that future-dated invoices are widely accepted. Backdating invoices is generally prohibited and often reflects weak accounting practices on the part of the issuer. Future-dated invoices are allowed. These are common when billing for subscriptions, rent, or services in advance, taking prepayments, issuing automated recurring invoices in Xero, QuickBooks, or Sage. A contract or agreement must exist. Future-dated invoices are completely legal and widely used. Backdated invoices are not allowed because they misstate revenue, create VAT discrepancies, cause mismatches with supplier records, and may be considered fraudulent. An invoice must never show a date earlier than when goods or services were delivered or earlier than the date of issue. Here are some useful tips for checking when you suspect a duplicate invoice. Step 1. Start with the invoice ID. Always begin with the ID because supplier duplication errors usually start here. Systems sometimes miss unusual IDs. Suppliers often reuse numbers by accident. Check. Does this ID already exist? Does it match the supplier's usual numbering style? Is anything missing or strange? Step 2. Supplier details. When reviewing an invoice, always take time to verify the supplier information carefully. Look out for slight variations in the supplier's name, such as LTD versus Limited, which can easily cause duplication errors. Check that the VAT number matches the records you already hold and confirm that the address is consistent with past invoices. Even small discrepancies in these details can be a warning sign of a duplicate or incorrect invoice. So if anything looks unusual, pause the process and investigate further before posting. Step 3. Date checks. When reviewing the invoice date, make sure it is not backdated, as this can misdate revenue and create compliance issues. Confirm that the date falls within the correct accounting period to ensure accurate reporting. If the invoice is future dated, check that this aligns with the supplier's usual billing pattern and is supported by the contract or agreement in place. Any irregularities in dating should be flagged and investigated before the invoice is processed. Step 4. Description of goods or services. Each invoice must include a clear description of the goods or services provided. This should specify exactly what was supplied, the date of supply, and the quantity involved. To ensure accuracy, you can double-check with the invoice approver to confirm that the items or services were genuinely ordered and have already been delivered. Any vague or incomplete descriptions should be clarified before the invoice is processed. Step 5. Amounts. When reviewing the amounts on an invoice, begin by checking the net figure, which represents the base amount before tax. Confirm that the correct VAT has been applied, and ensure the gross total accurately reflects the net amount plus tax. All calculations should be checked carefully to verify that the sums and totals are correct. In addition, confirm that the invoice is issued in the agreed currency for payment. Be alert to identical totals across different invoices, as this can be a warning sign that the same invoice has been submitted twice. Step 6. Purchase order or contract matching. When checking for duplicate invoices, it's essential to match the invoice against the supporting documentation. In many organizations, this means comparing the invoice to a purchase order or PO. However, not all suppliers issue invoices against POs. In those cases, the invoice should be matched against the relevant contract, agreement, or delivery documentation instead. Begin by reviewing all line items to ensure that each product or service listed on the invoice corresponds exactly to what was ordered or agreed. Pay close attention to quantities and descriptions, as identical entries across invoices may indicate duplication. Prices and rates should also be verified, since repeated invoices often carry the same figures as earlier submissions. Delivery or service dates must be checked carefully, as duplicates frequently reference the same completion date. Any discrepancies between the invoice and the PO or contract should be flagged, as they may represent either a genuine correction or a potential duplicate. This process matters because it prevents double payment by ensuring the same PO or contract is not billed twice. It also maintains accurate accounts payable records, avoiding inflated expenses, and reduces the risk of fraud, since duplicate invoices can sometimes be submitted intentionally to exploit the system. Finally, matching against POs or contracts speeds up verification, making it easier to spot repeated invoices automatically. Step 7. Final duplicate check. Exercise extra caution during the final review of invoices, as this is a stage where duplicate payments are most often detected. Pay particular attention if the supplier issues invoices frequently, since repetition increases the risk of duplication. Be alert when two invoices appear visually similar, when invoice amounts are identical or repeated, or when the layout looks generic or standardized. These are common warning signs that the same invoice may have been submitted more than once. Duplicate payments remain one of the most frequent sources of financial loss in accounts payable, so any suspicion should be investigated thoroughly before approval. But the most important is to maintain a clean supplier accounts. A well-maintained supplier master file is one of the most effective safeguards against duplicate payments. To prevent errors, avoid creating duplicate supplier accounts, and regularly review the database to merge any duplicate entries. Ensure that all supplier contact details, including addresses and VAT numbers, are kept accurate and up to date. Most importantly, reconcile accounts payable records against supplier statements before each payment run,
or at least on a monthly basis. This step ensures that invoices are matched correctly and discrepancies are identified early. Best practice is to use your preferred accounting software, but even a structured Excel workbook can be effective. If working in Excel, assign each supplier their own tab. Attach a screenshot of the supplier's account from your accounting system and include a screenshot of the supplier's monthly statement. As you reconcile, tick off each invoice once it's been matched. Following this process protects the business by catching duplicate invoices, identifying missing invoices, spotting incorrect amounts, and preventing fraudulent requests.
And finally, it is worth noting that a receipt is not a legally required accounting document. A receipt serves only as proof of payment, issued once money has been received. In contrast, an invoice is a formal request for payment. Put simply, invoices request payment, while receipts confirm that payment has been made. From the clay tablets of ancient Mesopotamia to today's modern digital accounting systems, invoices have always served a single purpose: record the truth, track obligations, protect the business. By understanding invoice structure, numbering, receipts, dating rules, and performing thorough duplicate checks, even a beginner can become a confident and reliable bookkeeper. Thank you for joining us on this journey through the history and practice of invoicing. Keep your accounts accurate, your records clear, and we'll see you in the next video.